My colleague Sonal Bhutra is standing by with more on the impact of indexation removal. Over to you, Sonal.
Thank you so much for that. Well, yes, this budget came with a lot of changes in capital gains in different asset classes. A notable one was changes in property taxes. The government has lowered the capital gains tax on long-term capital gains from 20% to 12.5%. That sounds like a great news, right? But there's a twist here. While the tax rate has been cut, the indexation benefit has been taken away by the government. What is indexation? Indexation adjusts the purchase price of an asset to adjust for inflation, thereby reducing the gains and ultimately the tax liability. Additionally, the finance minister clarified that property value indexed up to 2001 are grandfathered for capital gains. This means that indexation benefits won't be scrapped for old properties which are held before 2001. And that means if you bought property before 2001, 2001 will be the base for cost of acquisition, and if after 2001, then the actual cost of acquisition will be considered. The short-term capital gains will continue to be taxed at the slab rate. Now, these changes will come in effect from 23rd July 2024. This boils down to the question, is this good for a home buyer and a seller? Would this deter home buyers for buying a home for investment purposes? While the government has indicated the effective tax rate will be beneficial for the home buyers, analysis suggests otherwise. This move will not impact those buyers who sell a house and reinvest in a new house, as they can offset past capital gains on sale of old house and reinvest those in a new property. This has to be done within 2 years of sale as per Section 54 of the Income Tax Act. But what about those who are investing in assets other than property or not investing this money at all? This is here where it gets tricky. An analysis by CLSA indicates it will impact relatively shorter-term investments where market price growth is less than 10%. However, the impact of this new regime would be neutral or marginally beneficial for investments with longer holding period, that is more than 10 years, but where property price appreciation is more than 10% per annum. They add markets like Bangalore, Hyderabad and Pune, which are end-user driven markets, will be the least impacted, whereas markets like NCR and Mumbai, which have higher investor activity, are likely to be adversely impacted. Home buyers who are largely investors who were previously utilizing property sales to offset capital gains tax burdens may reconsider their purchasing decisions due to removal of indexation benefits, which could temporarily dampen sales velocity. Ambit also says the lower LTCG rate may incentivize short tenure property investments, as potential returns could outweigh loss of indexation benefits. But the average rise in home prices in top Indian cities is about 20%, but that is just in the last 2 years, according to the Housing Price Tracker report released by the real estate lobby CREDAI and data analytics firm Liasis Foras. This is coming after the big turn in real estate cycle that started post-COVID. Before that, the industry has been facing a lull in terms of demand and pricing, and prices only risen anywhere between 7 to 9%. The benefit from new regime will come in only if it is more than 10% price gain for any buyer or seller, which we have not seen in a long time. The indication is now the home prices would remain subdued, anywhere between 5 to 7%.
Right, thank you, Sonal, for that comprehensive explainer on what this means and the impact on the home buyers and sellers. With that, it's a wrap on our special broadcast. More news and updates continue. Stay tuned to CNBC TV.